All right, good evening, ladies and gentlemen. Today I want to do performance management and the transfer pricing. Actually, my aim was to make sure that we do this today and Saturday, but I understand my colleague will be taking you through a revision class on Saturday. So I'm forced to just do with you this class. Then you attend with my colleague on Saturday. I think you'll be covering various aspects. Then we'll continue and finish it off on Wednesday next week. Right, so this week we'll be dealing with the performance management and transfer pricing. Right, you should understand that in an entity, usually they are divisionalized. There are various ways in which the entities are divisionalized. Please, you can go and check in your study guide. I will not talk much about that background information. I'll just give you a background, then you go and look at it in your recommended text and your study guide. Right. What happens is most organizations, they are divisionalized. To properly manage an organization, you might need to subdivide it into various areas. The divisionalization can be in various ways. It can be, you can divisionalize by geography, that is according to location. For example, you can have the Gauteng entities under one department. You can have the Western Cape under one department. You can have the Mpumalanga under one department. You can also divisionalize by product. For example, you can have those manufacturing women's clothes in one department, those manufacturing men's clothes in one department. You can also departmentalize by function. For example, you can have HR on its own, finance on its own, production on its own. But you would find that most organizations, they follow what is called a matrix structure. With a matrix organizational structure, there's a combination of by function and maybe by product or geography. We can have, let's say, for example, the Gauteng branch, right? Our Gauteng division may have under it children's clothing and men's clothing, right? Then under each, they can be finance, they can be HR and stuff like that. So that is a matrix structure which combines the various ways in which other organizations can be, like in the various ways in which we can divisionalize an entity. So please, you can check in your recommended text the various ways in which we can divisionalize our product, our departments, right? Now, this will result in what we call a division responsibility centers, right? Right, performance management. Right, dividing the entity into smaller, manageable parts will result in responsibility centers. Please, what I was talking about, you can please go in your books and see the various ways that we can be able to differentiate the various departments. Right. We can have what we call a cost center. A cost center, it only accumulates cost. Right. Only accumulates cost. And you would find that management will be judged based on the controllable costs. We have what we call controllable costs. Controllable costs are those costs that the management have got can affect through their decision making. Right. For example, if the manager is a choice on where to rent, that means the rental of the shop is a controllable cost. But if top management are the ones who decide where to rent, that will mean that the rent is not controllable. Right. Then we've got revenue centers. And when we say cost centers, like production, it might just incur cost and nothing else. Then we can also have what we call revenue centers. They earn revenues only, which is very rare. Because normally you would find that you can have an organization that has got the sales department, and maybe the salaries of the sales team are not under the sales department, they are managed by the HR. So their salaries will be under HR and their costs will be under HR. Then they will be judged based on what? The marketing team will be judged based on the revenue generated. So they are, so we would find that when we say it's a revenue center, it is responsible for earning revenue for the entity. So when we judge them based on the revenue earned, right? Then we have also what we call a profit center. Right, a profit center, it incurs costs and earns revenue. Let's say you've got the Pretoria branch for Pick and Pay. On its own, it has got costs, it has got revenues. So it earns a profit. So when we are trying to assess the performance, we'll assess it based on the controllable cost and the profit. Right. Then we've got an investment center. Right. In addition, earning revenue and incurring costs. The center also is also responsible for making decisions related to working capital and non-current assets. So they also decide which vehicles to buy, which furniture do we need, what machinery should we buy. So that will be an investment center. But you might have other shops. Let's say we've got a shop, a Pick and Pay. Maybe it's head office that determines the assets that are supposed to be at each and every center. Right. So if head office decides, but the shop only sells and buys goods, that will mean that the center is only a profit center. Right. So an investment center, it will mean that the management are also responsible. When we're talking about investment center, we don't just mean it has got assets. That's not about having assets. It's about having the decision to acquire such assets. So when we judge whether it's a revenue center, cost center, profit center, investment center, we are focusing on the decision-making part. So it can be a revenue center because the costs that they are incurring, they are decided by a top management. So they are only responsible for what? For the revenue. Is that right? So we're saying when we talk about a investment center, so we can have a shop which has got furniture, which has got machinery, but it's not an investment center. Why? Because head office is the one buying the machinery. Head office is the one deciding the structure of the shop. Maybe we've got let's say you open your shop, which is called LK Furnitures, and you have got a structure according to head office that each LK shop should have. You have got the furniture that needs to be there, and in all provinces you follow that structure. That means management have nothing to do with how the assets are, which assets are acquired. That is a head office decision. So that center, although it has got assets, it will not be an investment center. So for the sake of management accounting, when we say an investment center, we mean the management at that local level are the ones who make the decisions regarding the investment. right? And also you should know that it can be an investment center when the particular department or division does not make all the decisions. As long as it makes some of the decisions, we'll only consider those assets that they make decisions on, right? So the issue here is we should only judge managers based on what they can control. So it moves away from just saying, let's just find the profits of each division, because it doesn't make sense for us to judge the Pretoria branch on costs that were decided by head office. So when you are judging a manager in this division, let's be able to evaluate their performance based on what? On the costs and revenues that they can influence, the investments that they can influence. Right. So we've got various parameters that we can be able to use to judge to evaluate the performance of an entity. So metrics that can be used to evaluate performance of divisions. Normally we just call divisions in this module, but they can be called departments or whatever it is. It's just one and the same thing. Right. We can be able to determine what is called a controllable profit. This is equal to the revenue minus controllable costs. So we move away from the normal accounting way of just subtracting all costs. Here, we only subtract the controllable costs, right? What do we mean by controllable costs, right? Controllable costs these are costs that can be influenced, affected by decisions made by the division's management. For example, rental costs, if the management make the decision on where to rent. Right. So that would be a controllable cost. Now, for example, if head office are the ones who find places and just tell you, go to this place to rent, when we evaluate your performance, we are not going to take that rent into account because it's not a controllable cost. It's unfair for us to judge you based on what you can't determine. So that's what we call a controllable profit. Right. Then we also have what is called residual income. Residual income, this is equal to controllable profits minus cost of controllable investment. Right. A controllable investment is equal to the controllable assets minus controllable liabilities. So that means all the assets and liabilities that you as the manager, that the local management can be able to influence. Right. So this will give you a controllable investment. Then your cost of the controllable investment. Cost of capital. Multiplied by the controllable investment. Right. Then we also have another metric. So I've shown you two metrics. This is the controllable profit and also the residual income. These two are just a measures that will allow us to calculate this. So here I was just showing you this controllable investment, where we get this controllable investment here. Then here I'm just showing you where we get the cost of the controllable investment. So these two, they actually help us when determining the residual income. Right. Then we also have another metric. So maybe let me number them. 1, 2. So the other two, those ones we're trying to just give us information on the other one. Then we also have what we call the return on investments. Which will be this one is relative. That's why it is usually considered the best measure, because it's relative. Controllable profits multiplied by 100 over controllable investment. So these are some of the measures that we can use to evaluate the performance of a division. So you would find that an entity normally has a target. So they can say that our target is to have a return on investment of 10%. So now management will now be judged based on whether they achieved that return on investment or not. And normally these parameters will also determine whether or not there will be a performance, sometimes whether there will be a performance bonus or not. So you will have to check whether the management managed, the divisions managed to reach the target, so that they can be entitled to the bonus or not. Any questions before I proceed? Right. If we don't have any questions, then I'll proceed. Right. So I want to illustrate this through the document that I sent earlier. Right. So guys, we also want to do transfer pricing. So first of all, I'm going to concentrate on the areas that have to do with this part of division performance management. Then I'll come back to transfer pricing and do the areas that have to do with transfer pricing. But today I want to make sure that I am able to calculate the return on investment and residual income. Right. So I will use these questions to illustrate. Right. We have got here Biancino Private Limited manufactures coffee products. The company has two divisions managed by independent management teams, namely the coffee division, which manufactures instant coffee that is sold to grocery retailers, and the cappuccino division, which manufactures instant cappuccino that is sold to vending machine providers. Both the instant coffee and the instant cappuccino are sold in powder form. The cappuccino division currently acquires the instant coffee from an external supplier at a cost of 40 Rand per kg. The company is investigating the possibility of transferring the instant coffee needed by the cappuccino division from the coffee division. The cappuccino division will save 3 Rand per kg procurement costs if the instant coffee is transferred internally. Okay, we'll deal with that at a later stage. I think we did that also, that part, but I will redo it. I was just rushing before I taught you the concept when I did that. So this time around, I will make sure that we deal with it properly. Right. Now, our part that we want to deal with is part E. Compare the performance of the two divisions' actual results based on the return on investment. That is round your answer to one decimal place and residual income. Right. So we want to compare the performance of the two departments based on the actual information, and then we have to calculate number one, the return on investment. So when they say return on investment, we need to calculate the controllable profit and we need to calculate the controllable investment. So remember that it's controllable profit over controllable investment times 100. Right. So we need to calculate that. So please, that means when they ask you to calculate the return on investment, the first thing that you have to do is to calculate your controllable profit and to calculate your controllable investment. That's the first thing. Then when you have those things, you can calculate your return on investment. Right. So let's go and calculate this is the current year's information that they're talking about. Right. The company is evaluating the current year performance of the divisional chief operating officers based on the division now return on investment. The company's cost of capital is 18% per annum. So this is what we're going to use to determine the cost of the controllable investment. Right. This is where I want us to move together, my friends. Right. The head office is responsible for all long-term financing agreements and also determines the rate and method of allocating the head office administration fees. So head office is determining long-term financing. So what is the implication? That means when we evaluate the divisions, we don't take the long-term loans into account when determining the controllable investment. Right. So we don't take the long-term loans into account when determining our controllable investment. Is that right? Right. Then we move on also. Then number two, we know that long-term loans will also have interest. Long-term loans will also have interest. So the interest on the long-term loans should also not be taken into account when determining the controllable profits. Right. While the cappuccino division is responsible for their own procurement function, negotiations with suppliers, the coffee division's procurement function is managed by the head office due to a breakdown in coffee division's procurement function. Right. So a cappuccino is responsible for procurement, but coffee is not responsible for their procurement. So what is the implication? When we deal with coffee, we should remember that any procurement related costs and revenues and the assets and liabilities should not be taken into account. Everything to do with procurement should not be included when we deal with coffee. But when we deal with cappuccino, we'll have to include them. Right. Head office delivers training services at a standard tariff to the divisions at the request of the divisional management. Right. Although head office delivers this training service at a standard tariff, but it is the divisions that request this training. So the training services will be taken into account when we determine the controllable profit. So we'll take into account the training services because it's management who are requesting the training. So they affect that. Right. The following each division, is responsible for credit management of debtors, non-current assets, investments, decisions, day-to-day cash management, and other sundry expenses. So we will know that they control anything to do with debtors. So we include it in evaluating their performance, everything to do with non-current assets, cash, and other sundry expenses. They control that, right? Then the following actual financial results for the AO were obtained from the respective divisional trial balances, right? We're given revenue, net income, non-current assets, debtors, creditors, bank overdraft, long-term loan. Net income was determined before the following income and expenses were taken into account, right? My friends, we should be very careful because the answer will change if they say before and if they say after. When they say before, that means you have to identify the items that are relevant and treat them in the normal way that they are supposed to be treated. If they are supposed to be subtracted, subtract. If they are supposed to be added, you add. So you will be mainly interested in the relevant items which are supposed to be included. But if they say after, the following were taken into account. If they say after, now your focus will be in the opposite direction. You will now be looking for those things that have been taken into account, which were not supposed to be taken into account, and then you reverse them. So you'll be doing a reverse process. That means if it was supposed to be, if it was added, you have to subtract it. If it was subtracted, you have to add it. Let me repeat so that you can understand. When they say before the following income and expenses were taken into account, that means you have to identify the income and expenses that are relevant for what you want to do. Like in this case, we need the controllable profit. So all controllable incomes and expenses that are below there, if it's an income, we'll add it. If it's an expense, we'll subtract it. So we will be interested more in those incomes and expenses that are controllable so that we can add them or subtract them accordingly. But if they had said after the following income and expenses were taken into account, our focus was going to shift. We're now going to look for those that were included, which are not supposed to be included. Then we're going to reverse them. That means if it's an income, we're going to subtract. If it's an expense, we're going to add. So that word is very, very, very important. Right. Since we want to calculate the return on investment, first of all, let's determine our controllable profit. Right. Our first question wants us to determine the return on investment. For us to determine it, we need the controllable profit and the controllable investment. So before we even talk about the return on investment, let's first determine our controllable profit and our controllable investment. Any questions before I proceed? Right. We have the coffee division and the cappuccino division. Right. So we'll start with the net income that they already have. So since they said before, remember I said now our focus will be on the things that are relevant so that we can either add them. Right. Our net income were given here. So please, these are in thousands. So if they are in thousands, please guys, don't waste your time putting the zeros. It will be advisable to also work with the thousands unless told otherwise to avoid writing a lot of zeros. Right, is that okay? So in case your question, you are in an exam and your question talks about thousands or millions, try to use those ones that are given. It can help you in terms of you will not have to include a lot of zeros there. Right. So we have 28,200. Then there is 9,400. Here, I want you to be following me here. Right, these things were not included, these ones. So we have to include them if they are relevant, and then we exclude them if they are irrelevant. Right, interest paid on long-term loan. This will be irrelevant. Why? Because we are told that head office is responsible for long-term financing agreements. Head office is responsible for all long-term financing agreements. So at the end of the day, the management of the divisions do not affect decisions relating to long-term loans. So the interest that is related to the long-term loans will be regarded to be an uncontrollable cost. So it will be regarded to be an uncontrollable cost. Any questions there? Right. So we can just say interest on long-term loan, or you can leave it if it's in an exam scenario. Uncontrollable. Decided by head office. So we'll not include the interest on the long-term loan. Right. Then we have got interest on bank overdrafts. Right. The interest on bank overdraft, we have to include it. Why? We are told that each division is responsible for own credit management of debtors, non-current assets, investment division, day-to-day cash management. So the bank overdraft is part of the day-to-day cash management. So they are responsible for their day-to-day cash management. So we're going to subtract it. It is their controllable expense. Interest on bank overdraft. Uh, 55, 15. Right. Then we've got training services. This is a controllable cost because although this training is offered by head office, but it's the division that requests. Since the divisions are requesting, this is a controllable cost. So there will be training services. So regardless of the fact that the tariff is set by head office, but they request the training. Right, so that will be 2160 and 720. Right, so you'll be checking whether they have a say in those things. Discount received from creditors. Right, if you still if you know your procurement process, a discount received is part of procurement. And we've been told that while Cappuccino is responsible for their own procurement, including negotiations with suppliers. Remember, discount received, they are received from negotiations with suppliers. The coffee division's function is managed by head office due to a breakdown in coffee division's procurement function. So that means our discount received will include for the cappuccino because they are the ones handling it. but for the coffee, we're not going to include. So that means this discount received will include only for the cappuccino, this 25. Right. So they have discount received from creditors. Right. Any question? Right. Then we have got discount allowed on debtors. This is controllable considering that we're told that each division is responsible for their own credit management of debtors. Remember that discount allowed is a part of the expense related to debtors. So we're going to subtract that. A discount A received I added because it's income. But discount allowed is an expense. So we're going to deduct 80. Right. Then we have depreciation. Right. The fact that each division is responsible for non-current assets. Each division is responsible for non-current assets. That means we'll also take into account the depreciation. So here it's unlike that relevant costing, whereby we say depreciation is a non-cash item. Here, when we calculate our residual income, depreciation is taken as a normal expense, but only if the responsible division management is responsible for the non-current assets. So would include the depreciation.
Sorry, Mr. Eugene.
Yes, my boss.
Discount received from creditors. You included it in the cappuccino division and not the coffee.
We'll include it in the cappuccino because the cappuccino is the one that is responsible for their. Remember, while the cappuccino division is responsible for their own procurement.
Oh, okay.
The coffee division, its procurement is managed by head office. So we own the coffee are not managing their procurement. So we don't include for the coffee because they are not the ones who are determining it.
No, it's clear. Thank you.
Thank you, sir. Right. So the depreciation 1 200 and 450. Please, guys, let's move away from our relevant costing, whereby we say when we are doing relevant costing, remember we don't include depreciation. We say it's a non-cash item and a product of an accounting policy. But when you are determining your controllable profit, you include depreciation as long as the local management, the division of the management of the division are responsible for the non-current assets. Right. Then we have head office administration fee. This one is not controllable because we're told that the head office is responsible for long-term financing and also determines the rate and method of allocating the head office administration. So it's unlike that training whereby the divisions were requesting. Now this one, even the method of allocating that. So all head office allocated costs, they are not controllable. Right. So a head office administration fee, that means it will not be controllable. Allocated by head office. Right. So that is not controllable. Sundry expenses, I think we're told that each division is responsible for their sundry expenses here. So there will be a controllable expense. Right. So then we can get our controllable profit. All right, my friends, if they'd said that that net income was after taking these into account, instead we're going to include these things that we didn't include. That is the interest on long-term loan, the head office administration fee, and the discount on the coffee. Those are the ones that we're going to take into account. But instead, we're going to reverse them. That means like interest on long-term loan, we're going to add it back. Because we're going to say it's wrong that they included it in controllable profit. So please, you should be very careful there. So this is our controllable profit. This is how we calculate controllable profit. So that means you only include all those expenses and incomes for which the division's management can affect through their decision making. And you exclude all expenses and incomes which are not affected by the division's decision making. Any questions? Right, we now have our controllable profit. But remember, to calculate our return on investment, we also need the controllable investment. So let's calculate the controllable investment. Remember, a controllable investment, it's current controllable assets minus controllable liabilities. Controllable assets minus controllable liabilities. Whether an asset or a liability is controllable depends on the information that we're given. Right. So we'll go now on the assets and liabilities. On the assets and liabilities on the top part. We start with non-current assets. Non-current assets. We know that each division is responsible for their non-current assets. So we'd include them. So leave non-current assets. So if they were not responsible, then we're not going to include the non-current assets. That's 43,000 and 14,000. Right. Then we have got the debtors. 10,800 and 3,600. Remember that, okay, before I include, I have to show you why. We're told that each they are responsible for their own credit management of debtors. So we include 10,800 and 3,600. If it's an asset, we add. If it's a liability, we subtract. Right. Then creditors. Remember that Cappuccino is responsible for their own procurement, including negotiations with suppliers. So for Cappuccino, would include the creditors. But for the coffee, we're not going to include it because their procurement and all their transactions to do with creditors are managed by head office. So for the coffee division, we're not going to include the creditors because they are a product of the procurement decision making. Right, so we'll have our creditors. Here it will be 0. And there would subtract. Remember that creditors is a liability. Creditors is a liability, so that's why we are subtracting. Bank overdrafts, we're going to include it because we're told that each division is responsible for their day-to-day cash management. So whether it's a positive or a negative balance, it will be included in their controllable investment. Since it's an overdraft, it's a liability, so we subtract. Since it's an overdraft, it's a liability, therefore we subtract. Then long-term loan. We're told that head office is responsible for all long-term financing agreements. So long-term loan, we're not going to include it. head office responsibility. Right. Then we find our controllable investment. So that's our controllable investment. Any questions? Right. Then we can now calculate our return on investment since we now have the parameters that we need. All right. Remember, it's controllable profit right. So would calculate for the coffee division. Right. Our controllable profit is 3905 and our controllable investment is 52,600. So we're going to say 3905 multiplied by 100 divided by 52,600. What do we get?
$26.44.
It's what?
26.4%.
26.4%. Thank you, guys. Doctor, how is it?
I'm well, thank you, teacher.
Thank you, doctor. Right. Then the cappuccino division would say 4610. What do you get?
30.73 or 30.7.
30.73. Right, thank you, guys. So that would be our return on investment. Whether it's good or bad, usually it depends on the target that they have as a company. Right. Then that was part one, I think. Let me just give the numbering here so that some of our friends are not in the class. They might need to understand, so they might not understand. Then number two, residual income. Right. We'll have our controllable profit. Remember that is controllable profit less cost of controllable investment. Our controllable profits, we have it. We've already calculated it here. This one. Less the cost of the controllable investment. Right, now to get our cost of the controllable investment, we multiply the cost of capital or required return. That is the 18% times the controllable investment. So it will be 18% times the controllable investment for each entity. So would say, remember that the controllable investment is here, 52,615,000. So would say right. What do we get? Thank you.
2.7 for Cappuccino.
It's what? 2.7. Okay, thank you so much. Thank you, guys. Thank you so much, guys. Right. Then we get our
Eugene,
yes,
are
my
they
boss.
both multiplied by 18%? I think the other one you put 15%.
Oh, sorry. Thanks so much. Thanks so much, my boss. This is 18. Does it still give us 2.7?
Yes.
Okay, thank you, my boss. Thank you so much. Then we get residual income. That's the residual income. Right. So this is the, so also whether they are acceptable or not will usually depend on the targets. Right. They said compare. So we're saying although the coffee division is a higher residual income, the cappuccino division performed better with a higher return on controllable return on investment. The return on investment is considered superior as it relates the profit end, that is the controllable one, to the what? Investment. Because you see what is happening here, we can say this was, they made 4,000, but let's remember that they've got an investment of 52 million. Whereas this one, they only have 15 million, but out of 15 million, their investment is almost more than almost 3.5 times the investment of coffee. It's almost 3.5 times that of cappuccino. right? But this one's made, but if you look at their residual income, it's just almost half, just slightly above half. So we can see that this method now, it's considered better because it relates whatever you have as a profit to the quantity of the investment. Because you can have one business having a huge profit simply because they've got huge capital. So for us to make more sense, if we relate the profit to the capital, it will now bring more sense into the equation. So that's why usually the result that is given more weight is the return on investment more than the result of the residual income. Because it's unfair to compare the residual income of a firm with 52.6 million in capital to one that has got 15 million. Then we just consider the size of the residual income. But now with the return on investment, it then relates whatever profit you earned to the investment that was made in that company. Any questions? Right, if we don't have any questions, then I'll go to the other one. Let me see the better one here. Right, I'll do number 3. So at your own time, you will do number 2, F and G. At your own time, you try to do number 2, F and G. I'll go for number 3. Right, Bumbulo Milling Limited is a maize milling company in the Rustenburg area of the Northwest Province. Right. The company is 100% owned by the Bumbulo Family Trust, established by Mr. Farmer Brown, a sole representative of the trust of Bumbulo's management team. The milling site is well situated as the company can easily access maize corn from the farming community of both Gauteng and the Northwest provinces. The company uses direct costing method for inventory valuation. Right, let's go to the required performance management. Right. I want us to look at this one. Part C. On the basis of return on investment, determine if the animal feed processing plant manager will receive a bonus or not. So now, normally when they ask you such a question, there will be a targeted performance in terms of that return on investment. So we have to see if he is going to reach that. Let's see if we have got anything on that. Right. Right, I think it's here. Mr. Farmer Brown and the management team have decided to expand their operations by investing in an animal feed processing plant. This plant will produce animal feed for the livestock industry. To maintain consistency across the group, the performance of this plant manager will also be measured on the basis of the return on investment. Let's remember that is the controllable profit over the controllable investment. Controllable profit divided by the controllable investment. Right. Then based on this performance measurement technique, Bumbulo's manager are entitled to receive a bonus if they meet or exceed the target return on investment. The newly appointed animal feed processing plant manager, Kabelo Bupi, Yes. However, raised concerns about the fairness of the performance measurement system currently in place. The following information has been gathered with regard to the proposed operational expansion. Right. Let me just make sure that we, okay. The company's annual target return on investment is 20% per annum, or number 9 here. Right, so let's read and see. So that means we take our sales and then we subtract any controllable costs. Right, Kabelo Bupi was appointed at an annual cost to the company of 550,000. Right, you will take a full management responsibility of the plant's operations, long-term investment decisions, human resources, and procurement functions. So you'll be responsible for everything. Right. So let's do the calculation of the controllable profits. Right. Remember that our controllable profit is the revenue minus controllable costs. Our revenue. Let's find out what will be our revenue. Right. Our revenue. I just want to check our revenue here. Right. We get to number 11. Animal feed will be sold to the retailers at a selling price of 9,900 per ton. And the related selling costs per ton will be 15. So we have to find out how many tons would they sell. So it's 9,900 per ton, and there will be 15. Let's find the output. How many tons? Right. Okay. Let's go to number 2. The new processing machinery will be bought at a cost of 7.2 million. The machinery will have an initial processing capacity of 150 tons per month. So it's 150 tons per month. All the tons processed will be sold. That means there will be no inventory. The estimated useful life of this machine is 10 years from the date of purchase. So it's 150 tons per month. So we should be very careful. So we would say 150 times 12, because the 150 is per month. So to find the annual, we'll multiply by 12. Then we'll multiply by the price per ton, which is 9,900. What do we get?
$17,820,000.
Right. Then we would have less controllable costs. Right, unless told otherwise, we assume, remember that unless told otherwise, we assume that all costs are controllable, unless told otherwise. Right, we're told that you will take full responsibility of the plant's management. So considering that he is the one in charge of the full responsibility of the management, we can also take this cost as part of the cost of the division. Right. So let's say the manager's salary. So you should also be very careful when they talk about. Okay, thank you. Thank you, colleagues. Right. So unless told otherwise, we would assume that they are controllable. Right. Then there's also the a machine which was bought for 7.2. And it will have an estimated useful life of 10 years. So there will be depreciation there. And we know that Cavelo will be responsible for all responsible for plant operations, long-term investment decisions. So the depreciation will be part of his decisions. So they have our depreciation there. So unlike if you see relevant costing, we're going to check the full 7.2 million. But here we don't take the 7.2 million, we take the depreciation, the annual depreciation. Right, that is 720,000. Because this guy will be responsible for all the long-term investment decisions, right? And all HR decisions. Right. The animal feed specialist will be hired at an annual cost of 300,000. The specialist will be responsible for the entire animal feed production process. Right. So we have animal feed specialists. Remember, he is responsible for all hiring. Right. In addition to the already available delivery trucks, the company will invest in a 3-ton truck at a cost of 350,000. This truck will be used 60% in the animal feed processing plant and 40% in the milling site. So the depreciation of the plant will only take the 60%, which is for the animal feed part. The truck will have an estimated useful life of 5 years. Right. So we'll have depreciation of the delivery truck. $350,000 divided by 5, multiplied by the portion. That will be for the animal feed, which is 60%. Thank you. 42,000. Then animal feed direct material will either be purchased from the milling site or from external suppliers. At the moment, the purchase price per ton of chop in the market is 6.9. Additional direct material required will cost 300 per ton. So we'll have animal feed at 6.9 per ton. Animal feed. Remember, our tons are 150 times 12. Then multiply by the cost per ton, which is 6,900. What do we get?
$12,420,000.
Thank you so much. Then we have, on that same statement, there are other direct materials. We're told that there are additional direct material of 300 per ton. Additional direct material. $150 times 12 times 300.
$540,000.
Then Bumbulo will appoint 3 full-time general workers to work at the plant at a monthly cost to the company of 6,500 each. You'd be very careful. There are 3, and the month it's a monthly cost, so we should multiply by 12. And the 6.5 is for each, so we should multiply by 3 there. So they have general workers. 6.5, the salary per month, multiply by 3 because there are 3, then multiply by 12 because we have 12 months. What will we have there?
$234,000.
Thank you. Right. Then variable manufacturing overheads cost per ton will be 400. Variable manufacturing overheads 400 cost per ton will be 400. Unless told otherwise, as I said, we should assume that they are controllable. $150 times 12 times 400. What do we get?
$720,000.
The fixed manufacturing overheads, excluding depreciation, related only to the animal feed. So it's related only to the animal feed, so it becomes relevant, will be 50,000 per month. Other fixed manufacturing overheads, fixed multiplied by 12. That should be 6 million. $600,000, I think. Right. Then the company say, okay, that's the targets. Financing of the machinery and the truck will all be arranged by Bumbulo's management team. Right. So you see the financing of the machine and the truck will be arranged by Bumbulo's management. Bumbulo is the main company. Here now we're talking about the animal feed. Remember that Bumbulo is the main company. Right. So the financing will be arranged by the main company. Right. The initial indicators are that the interest rate will be 13%. Right. So the interest on financing, we can say not controllable. It will be arranged by head office. Animal feed will be sold at 9,900 per ton, and the selling cost will be 15 per ton. The sales we've already included it, but the selling cost $150 times 12 times 15. What do you get?
27,000.
27,000. Then we get our controllable profit. Then calculation of controllable investment. I think I only saw 2 assets there. If my memory serves me right, for which we calculated the depreciation. Right. There's the new processing plant at 7.2 million. So let's machinery. 7.2 minus our depreciation, which is 720,000. Please note that our assets, we include them at, just like in accounting, cost minus accumulated depreciation. So that means in the second year, it will be 7.2 million minus 720 times 2. What do we get?
$6,480,000.
Thank you. 6,480,000. Right. Then we also had with was it a trucks, which was bought at 350. I think those are the only two assets that we have. And the depreciation, we calculated it above 42,000. We get 308,000. Long-term financing. Not controllable, since head office decides on that.
Mr. Eugene, can
Yes.
I ask, since the depreciation for the truck was apportioned based on the percentage, can't we apportion also the cost of the truck?
Yes, we should. Thank you so much. Thank you so much. I'd actually overlooked that. So we have to multiply this by 60%. Because this department only has 60%. What do you get? Sorry, the what? Not the overall. Sorry, actually the 42 is already multiplied the. Sorry, we should not even. We should multiply the 350 times 60%. Remember, the 42 is already taken into account the 60%. So now, if we multiply the 60% outside the bracket, we'll be doing it twice on the 42. So we only have to multiply the 350 only by 60%. Thank you, Mtandeni. What do we get? 168,000. Right. So that's it. This one will be zero, the long-term finance. We don't have other assets. We didn't give us any current assets, current liabilities. So we'll just get our controllable investment. Right. Then our return on investment. Remember our formula. One 667. What do we get?
$25.08.
25.08%. Thank you, guys. Then we now compare what we got now to the target. We now compare to the target. Remember, there was the target. The target was 20%. So that means the target has been met. So that means the manager will receive the bonus. the manager will receive the bonus considering that the return on investment of 25.08% is more than the target of 20%. Right. Any questions there? Right. So we'll continue in our next class. My main focus will now be on transfer pricing. Please also, maybe can you also read, recommended text, the behavioral aspects of performance management when determining the bonus and evaluating the bonuses, the other human aspects that can affect that decision and how it can affect the motivation of employees. Thank you so much. God bless you richly and have a blessed night.
Thank you.